Yep. Thank you. All right. Good morning, everybody. If you have your in-class group work, I'm going to collect it in a couple minutes, so make sure your names are on it and you can bring it up here. I graded over the weekend the chapter 6 in-class group work, and I think almost everybody didn't understand these last two questions, and so I just wanted to take a brief part of today's class and just talk about them quickly. Now, the first one says apply the lower of cost or market method to each inventory item. So when we're doing that, we just look at which one is the lowest, either cost or market, and multiply it by that amount, the number of units. And so most of you were able to get that first answer, but then when it's in total, okay. So the first part says take the lower of cost or market for each individual item. That is this column to the right. And so what we did was we selected the lower of the two. But now the instructions for the second part says apply the lower of cost or market method to total inventory to determine its value. So when we're looking at total inventory, we want to compare this one to this one. So remember, we're not taking each individual one and sorting it out. We're just saying, okay, this is at market value, or excuse me, this one's at cost, this one's at market value. And so we would just pick the lower of the two. So the answer for B would be that one there and that one there because it's the lower of the two. Any questions there? Like I said, there were pretty much everybody got it wrong. There were 2 students who got it correct. But other than that, you know, they just didn't read the instructions and it didn't come across clearly. So when it's on an individual basis, you look at the unit prices and compare them. When it's on a total basis, you compare the totals. Okay. Any questions? Okay, so now we're jumping back to example 7 on the chapter 9 handout number 11. And we're doing an example of straight line depreciation. And so remember the formula for straight line depreciation is our historical cost minus our salvage value. And that's going to be divided by the estimated useful life. And so here we have 700,000 is our asset historical cost. Our salvage value is 70,000. And we have to divide that by 5. And so our annual depreciation equals $126,000. And then it looks like our time period, straight line method, balance, and accumulated depreciation. So it looks like we have 3 years there, 2018, 2019, 2020, and 2021. Right? So 3 times the 126. And we get 378,000. And then we have to add 1 month. So we multiply it by 1/12. And we get 10,500. And so our total accumulated depreciation is 388,500. Any questions? Okay, now we're going to jump down and do a units of activity example. Grover Corporation purchased a truck at the beginning of 2020 for $109,200. The truck's estimated to have a salvage value of $4,200 and a useful life of 120,000 miles. All right. And so it's asking, what was the depreciation expense for 2020? So we're going to need this information. It was driven 21,000 miles in 2020. So our formula for units of activity is your historical cost minus your salvage value divided by the estimated total units. So in this case, it's going to be 109,200 minus the salvage value of 4,200. And we're going to divide it by 120,000 to get our cost per mile. And so that's 0.875 per mile. And we have to multiply it by the activity, which equals 21,000. And that's 18,375. Letter B. If they asked for what it was for 2021, what would you do? Right, you would just use the 29,000 instead of 21,000. And so your activity would be 29,000 times 0.875. Your rate does not change. Now, what do we have to watch out for? When we get towards the end of depreciation, like its useful life, when it gets close to say 4 or 5 years or wherever it hits the 120,000 miles, then you have to be careful and not to depreciate it below the salvage value. So you would never depreciate it below 4,200. You would just adjust that last year that they carried over. Okay. All right, take a look at example number 9. This is double declining balance. So Ramos purchased machinery that was installed and ready for use on January 3rd, 2020 at a total cost of $230,000. Salvage value is estimated at $30,000. The machine will be depreciated over 5 years using the double declining balance method. So what you do is you take the useful life and divide it into 1. So 1 divided by 5 equals 0.2 or 20%. And that's the straight line depreciation rate. We have to multiply that by the number declining balance. And so in this case, it's going to be double. So it equals 2. So 2 times 0.2 equals 0.4 or 40%. And then you multiply the double declining balance by the book value. So we had 230,000. We're going to multiply it by 0.4. And get 92,000. Okay. And so this is year 1, right? And we need 2021. So now we take the 230 minus 92,000 because that's going to be our new book value. And that equals 138,000. We're going to multiply that by 0.4. And year 2 is going to be 55,200. So it's letter B. Any questions? Now, again, on the double declining balance, or if it's triple declining balance or quadruple declining balance, whatever, you don't use the salvage value initially, but you don't depreciate below that 30,000 salvage. So if we made a chart and carried it out, that last year would have to be adjusted. Any questions? Okay, so let's jump on to the next page then. Okay, we're accounting for disposal of property, plant, and equipment. And so we have to make sure that we get rid of any assets on our book once we actually dispose of them. So we've got to make sure that we take it off our books and, if possible, record a gain or a loss. So under example 10, Ottawa Corporation owns machinery that cost $20,000 when purchased on July 1, 2021. Depreciation has been recorded at $2,400 per year, resulting in a balance of accumulated depreciation of $8,400. That helps us with book value, right? The machinery is sold September 1, 2026 for $10,500. Prepare journals to update the depreciation and record the sale. So the first thing that you've got to do in these cases is you've got to update the depreciation for that current year. And so we're going to have depreciation expense. And we know that it's $2,400, but we have to calculate how many months in 2026. So how many months? Close. 8, right? Good. We didn't go into September, so we just went up to. And so that's 1,600. And then accumulated depreciation is 1,600. Okay. So we have to remember to add it to this 8,400 for the next part, which part B says to record the sale. Machinery sold on September 1st for $10,500. So we're going to get cash, $10,500. We've got to get rid of the accumulated depreciation, which we know was 10,000. And we're debiting it this time because normally it's a credit balance, and so we're trying to eliminate it. We have to eliminate the machinery. Normally we would debit it, but we're going to credit it this time. And then we have a gain on sale of 500. How do we calculate the gain on sale? So we take the proceeds, 10,500 minus the book value. Let's do it separately. Proceeds minus book value. And so this would be 10,500 minus our book value, 20,000 minus 10,000 in accumulated depreciation. And so that equals 500. Any questions on that one? Okay, now we're going to use that same information, but we're going to assume the machinery is sold for 5,200 instead of 10,500. Now we still have to record the same entry to update the depreciation, 1,600. Oops. and accumulated depreciation for 1,600. And now our entry this time, we're only getting how much cash? Right, 5,200, good. And so when we get our proceeds this time, we have 5,200 minus 20,000 minus 10,000. And so this is going to equal minus 4,800 loss. So we have a loss on disposal. And this would be 4,800. And then we have to eliminate the accumulated depreciation. And that is 10,000. And then we have to eliminate the machinery for 20,000. Any questions there? Okay. All right. I'm handing out handout number 12. It's still chapter 9. If you could take one and pass them down after you finish writing everything down. There's some practice questions on the front for you to try. We'll go over them in a couple minutes. Yep. Okay. I'm probably going to need that. You can just call me Paul, by the way. I was going to let you finish class. Now I got to do it myself. Bless you. Okay, so let's talk about these. These should have been something that you had seen in your reading. And so there's some good practice questions for you. Costs incurred internally to create intangibles are, and here it's going to be expensed as incurred, letter C. So things like research and development here in the United States, if you're working on something, it gets expensed. You can't capitalize it as an asset. So we're talking about intangibles, and intangibles are things that are usually legally protected, like royalties, trademarks, patents, copyrights. And so the only existence of them is sort of a paper filed with the US office, and it's a legal paper. And so it's hard to say what you actually spent on it. And so we don't allow companies to put large amounts on the books that they could have spent on it. All right. Which intangible assets are amortized? So amortized is similar to depreciation in that we account for the expense partially over the indefinite assets, or excuse me, over the intangible assets useful life. If it has an indefinite life, there's no way to amortize it. Quote unquote, it should last forever. If it has a limited life, then you should be amortizing it. So we can think about like Disney, right? You can't use the Disney name because that's an indefinite lived copyright, right? But what can you use now? Right. The old Mickey Mouse, you can actually do things with because it's now entered the public domain. So that would have a limited life. So the answer here is B. Okay, when a company develops a trademark, the cost directly is related to securing it should generally be capitalized. Which of the following costs associated with the trademark would not be capitalized? So all the other ones are going to be capitalized, but research and development costs are not. Typically, by the way, these fees are externally generated, right? You're using outside attorneys, outside consulting fees, and design costs from outside. If they're internal, then they can't be capitalized. Hopefully you read about goodwill. It is something that we see much more of now that we're seeing combinations. So when you have a bunch of companies in a industry, they usually don't have a lot of goodwill because the only way you can get it is to buy other companies and buy their assets in total. And so what we've seen as companies get larger, so companies like Meta and Alphabet, they're buying other companies, Amazon the same way, and you'll see more and more goodwill get added to their books. And goodwill is essentially the amount they paid over the fair value of the assets. And it can only be recorded in a business acquisition or business combination. And so goodwill may be recorded when one company acquires another company in a business combination. That's letter B. A loss on impairment of an intangible asset is the difference between the asset's carrying amount and its fair value. And so that means if at some point in time you had, let's say, a patent for a specific technology, you expected it to last 7 years, but all of a sudden in that second year, somebody comes out with something that makes yours obsolete, then you would no longer be able to amortize it. You would look at it and say, okay, at this point, it's been impaired. I'm not going to be able to make money off of it. Nobody's going to buy my Zune if there's an iPod out there that's that much better. So that type of thing happens. And so you write it off to its fair value. So the answers were C, B, C, B, B. Any questions there? Okay, I try to strike a balance here of putting things in this that I know that you need to read, but you may or may not catch it. I'm not going to read all this to you, but if it's on here, it's something that you want to make sure that you're familiar with and that you understand it. So we move from assets to natural resources. So copper, oil, any of those types of resources that we're taking out of the ground. And so essentially what we have to do is we have to estimate what's there, and then we have to record all of our costs and divide it by how much we expect to extract. So our depletion rate is going to be equal to the cost of the resource divided by the estimated total units of resource to be extracted. Now, what goes into the cost of the resource? So this is like what we would put into buildings or land. Here, we're going to be putting it into a depletable asset. And so you have the purchase or acquisition costs. You have any exploration costs. You have development costs. And these are the tangible assets that are site specific. So this means if you have to build, let's say, a deck or something like that for the machine to come up on, the drilling machine, that is site specific, that asset. But the drilling machine itself, that can usually be driven from site to site to site. So that's not going to be part of your costs of the site. The site is anything that you're putting into it. So if you have to make a road to the site, if you have to clear off the site, if you have to put small units on the site, those things are all part of the cost. And then you have intangible assets like the well or site preparation. And then the last thing would be cost to repair any damages. And remember, sometimes you'll see that abbreviated as ARO, asset retirement obligations. So once they're done, theoretically, they've got to plug the well and then clean it up and restore it back to original condition. And step two, we're going to multiply that depletion rate by the quantity removed from the resource. So depletion expense equals your depletion rate multiplied by the amount of resource extracted. Keep in mind here, when you extract it, you create an asset, right? So when you're dealing with the natural resource, this is just telling you how much you've taken of what you have, but once you take it, you put that asset in the inventory and then you can sell it. So whether it be crude oil, or whatever it is, that's your asset that you're creating for this depletion expense. Any questions there? Okay, let's take a look at example one and I'll walk you through it. Okay, it says Barton Corporation acquires a coal mine at a cost of 1.8 million. Intangible development costs total 360,000. After extraction has occurred, Barton must restore the property estimated fair value of the obligation is 180,000, after which it can be sold for 210,000. Barton estimates that 6,000 tons of coal can be extracted. What is the amount of depletion per ton? All right, so we want to start with the depletion base, and this is the cost. And so we start with our purchase price, and that's 1.8 million. We add to it the intangible, BEV costs, and so that's 360,000. We add the asset retirement obligation of 180,000. And are we done yet? Should we take into account that we can sell some of those assets at the end for 210,000? Yes, right. So this is similar to the asset. So we're going to deduct our salvage value. So that's minus 210,000. And so our total is 2,130,000. And so we take our total and divide by estimated units of activity. Case that was 6,000 tons. And our cost per ton equals 355. And so that is answer A. Any questions there? Okay, let's look at number 2. Jaeger Corporation purchased a mineral mine for $5,100,000 with removable ore estimated by geological surveys at 2 million tons. The property has an estimated value of $300,000 after the ore has been extracted. The company incurred $1.5 million of development costs preparing the mine for production. During 2020, 600,000 tons were removed and 480,000 tons were sold. What is the amount of depletion that Jaeger should record for 2020? Okay, so figure out the base. Okay, and so we have the cost, 5,100,000. We have the development, 1,500,000. And we're going to subtract salvage. $300,000. And so our total, 6,300,000. And so total divided by the estimated activity. So we're going to divide by 2 million. Because that's how many tons. And we get a cost per ton, 6.3 million. Divided by 2 million. and that equals 3.15 per ton. So the extracted amount, 600,000 times 3.15 equals 1,890,000. And that extracted amount goes into inventory, while the expensed amount is the 480,000 times 3.15. And that equals our answer of 1,512,000. Or letter C. Any questions? Okay, you guys have practice question number 1 that you can try. Okay, so here what you're trying to figure out is what is to record the discovery of the deposits. What is the cost? So the costs incurred equal 480,000. The fair value equals 2.7 million. And so you record costs incurred, and that would be a debit of 480,000 to an asset account. Now, will you ever reap the benefits of that fair value? Yes, when you sell it, right? By the time I start to sell it, I'm going to be selling it at whatever this number is, 5 or 6 times the cost of 480,000. So you're going to be able to record that. Okay, now we're talking about intangible assets. And so what are intangible assets? Intangible assets are a non-physical asset that has value to a business and is not financial. Financial assets are considered investments. There are two types of intangibles. Broadly speaking, you have limited life intangibles, and those limited life intangibles are usually limited by the laws of the specific country you're in. So they talk about patents, trademarks, copyrights. If you go down to the US Patent, Copyright, Trademark Office, they'll tell you this lasts for 15 years, this lasts for 20 years, etc. There are times when those patent laws can change. We obviously have seen that in the past in emergency situations. So they do their best to just estimate what the life is and how long they're going to be able to generate cash flows out of it. So they should never depreciate anything longer than its legal life, but things can change, right? Especially with medicines nowadays. So I think you're probably seeing a lot of commercials on TV for Wegovy and Ozempic. It's weight loss. But those things started out as like something for skin to treat like eczema or something like that. And they noticed, oh, it's got a great weight loss component. And so if you can show that your purpose has changed, that can extend the life of your patent. But in general, you have limited life, and the companies amortize it over how long they expect to have cash flows from it. So even if they have a 7-year patent, let's say on computer equipment, think about companies like AMD and Intel. How quick are they changing their processors? Yeah, every year, right? RK is another one. They're making these processors faster and faster and faster, and part of it's being driven by Bitcoin mining, part of it's by computer gaming. So even if the office says they can have a patent for 7 years, they probably know they've only got 3 years out of it before that technology is completely changed. So instead of using that 7 years, they would use 3 years. So basically, management has some discretion in this case how long they should amortize it, but it shouldn't be longer than they expect to gain benefits from it. And when we talk about capitalize, these are the expenses. Are they going to become part of the asset, or are they just going to be expensed? So we capitalize, and we've talked about this already, any external fees like legal, drafting, etc. We capitalize any filing fees. These are fees by the government. And you may have multiple different fees in different areas, right? Other external costs necessary to obtain the intangible. And then this one happens kind of after the fact. Unreimbursed costs to successfully defend the patent. Now, oftentimes they'll get reimbursed for those. Oftentimes it'll do damage to their company. If it's a small company, it'll put them out of business. So those fees can be unreimbursed, but what happens to them is they get capitalized into the patent. And then of course, if it's purchased, you can always add the purchase cost. And so usually when intangibles are on the balance sheet at big values, that's what happened to them. So if somebody was going to go and buy Coca-Cola's patent for Coke or their secret formula for whatever, they could potentially spend billions of dollars, right? But Coke has that, if they still have it on their books, if it hasn't expired, as hardly anything because they can only capitalize these small costs. So that's when you see big jumps is when other companies acquire these intangible assets. Okay. And then the other one are definite life or indefinite life intangibles. So these will presumably last as long as the company lasts. So if there are no factors, legal, regulatory, contractual, competitive, or other, that limit the useful life of an intangible asset, a company considers its useful life indefinite. And that means they just put it on the books and they only check it for impairment. They're not amortizing it. So here's a little chart, some information, kind of a quick cheat sheet of it. Any questions? Now there are 5 types of intangible assets. They're kind of broken down, and this is, not something that's like hard and fast, but kind of give you an idea of what they are. There's marketing related intangibles, customer related intangible assets, artistic related, contract related, and technology related. And you have a little chart there with some examples. So it gives you the idea of which intangibles belong in which bucket. So now we'll jump into example 3. Intangible assets may be internally generated or purchased from another party. In either case, it is an issue of what costs should be included in the initial valuation of the asset. So identify the typical costs included in the cash purchase of an intangible asset. So what are some of the typical costs in an intangible asset? So you have the purchase price, legal fees, and any recording fees to the government. Part B says, discuss how to determine the cost of an intangible asset acquired in a non-cash transaction. So this would be something like if you were using stock to acquire it or something along that lines. In a non-cash acquisition, the initial cost of the intangible asset is either the fair value of the consideration given up, or the fair value of the intangible received, whichever is more clearly evident. So if I trade a patent for stock or a trademark for stock or another intangible asset, there's not usually a market for intangible assets, right? You can't go out and buy companies' intangible assets. So it's pretty hard to value them. And so let's say you use stock, it's easy to value the stock, right? We can get stock prices from a market that's publicly available. So you would use the value of the stock in that case. There are other ways, if both of which are not regularly traded items, that you can have professionals give valuations, and typically that's what companies would rely on if they don't have an easy way to measure the valuation. Let's take a look at example 4. So it says Alonzo acquires 3 patents for Shack Corp for a total of $320,000. The patents were carried on Shack's books as follows: patent AA 5,000, patent BB 2,000, and patent CC 3,000. And that's what you would expect to see, right? Legal fees, filing fees, a low value for internally created patents. Now, when the company acquired the patents, their fair values were 20, 240, and 60, which adds up to the 320,000. So at what amount should Alonzo record patent BB? And the answer is D, 240,000. And just so you know, when you record a patent, you would debit patent. So in this case, 240,000. And you would credit cash in this case because it says that they totaled it for 240,000. Now that's just part of this, isn't the exact entry for that, but that's what it would be. And then your example amortization of a patent would be a debit to amortization expense and a credit to patent. So we used to have accumulated depreciation with patents, and with trademarks or any other intangible, you reduce the actual intangible itself. Okay, let's take a look at example 5. Snyder Industries has 1 patent recorded on its books as of January 1, 2024. Patent had a carrying amount of 252,000 and a remaining useful life of 7 years. During 2024, Snyder brought a patent infringement suit against a competitor. On October 1, 2024, Snyder received the good news that the patent was valid and its competitor could not use the process. The company incurred $90,000 to defend the patent. Compute the carrying amount of the patent that would be reported on December 31st, 2024. Balance sheet assuming monthly amortization of the carrying value of the patents. So, initial patent, 252,000. We divide it by 7. And that equals 36,000 amortization per year. Now, on October 1, we capitalize patent defense costs, 90,000. And we're going to divide this by 75 months. And that equals $1,200 per month. 75 months comes from the 7 years less 9 months for 2024. And so $1,200 per month times 3 months. And that equals 3,600 plus the 36,000. Then we end up with total amortization of 39,600. And so our carrying value equals the 252,000 plus the 90,000 minus the 39,600, which equals 302,400. And now the entries. Description, we have patent for 252,000. Cash, credit 252,000. Then we have the legal expenses, so 10-1. It's going to increase the value of our patent. Sorry, I put that on the wrong line. $90,000. Probably paid the lawyers in cash. 90,000. And then 1231 would be our amortization entry. So amortization expense. Bless you. 39,600 and 39,600. Okay, once you're done with that, you can go through practice number 2 and just list the accounts that should be classified as intangible assets or circle them. Maybe about 2 minutes to do that, and then I'll go over them. Okay, so it's listed below as a section of accounts found in the general ledger, and they're asking which ones should be classified as intangible assets. So we'll just start and go through them. Accounts receivable, that is not correct. That is an asset. All right, current asset. Goodwill, intangible. Organization costs are not an intangible. Prepaid insurance, an asset, right? Not intangible. Radio broadcasting rights is an intangible. Premium on bonds payable, that's related to debt. That is not an intangible. Trade name is an intangible. Research and development costs are not an intangible. Internet domain name is an intangible. Initial operating loss is not an intangible. A non-competition agreement is an intangible. A customer list is an intangible. Video copyrights is an intangible. Notes receivable is a current asset. It is not an intangible. Any questions? Okay, let's take a look at examples or practice 3. You guys try this one. I'll give you about 2 minutes. Okay, so it says Finley Corporation purchased a patent for a new computer or consumer product for $960,000. So they're able to capitalize all of that, right? Because they purchased it. At the time of purchase, the patent was valid for 15 years. Okay, so that's helpful to us. Due to the competitive nature of the product, however, the patent was estimated to have a useful life of only 10 years. So in this case, we're going to use that useful life. So we have $960,000 for costs. Doesn't say anything about a salvage value or anything like that. So 10 years. And so we take and divide it out and we get 96,000 per year for C. And we will pick up here on Thursday, 11/7. We'll also have the Chapter 9 group project. If you haven't turned in 8, make sure you upload it online or hand it to me before you go. Make sure your names are on it. And have a great day. I'll see you on Thursday. If you haven't voted and you're eligible, vote.